For most of its 50-year history, Micron Technology has been one of the most frustrating stocks in semiconductors. Revenue doubles, then halves. The stock surges, then crashes. Every few years, a memory supply glut hits the market, prices collapse, and Micron posts losses that erase the gains of the previous cycle. Investors who held through every peak and trough between 2000 and 2020 made almost nothing. Well, Micron reports fiscal Q3 2026 results today, June 24th, after the U.S. market closes. Wall Street expects earnings per share of $19.72, against $1.91 in the same quarter last year. That's 932% earnings growth in 12 months. Gross margins are projected to cross 80% in a business that ran at 39% margins just a year ago. So, the most reliably cyclical company in semiconductors is having the best year in its 50-year history, and the margin numbers look nothing like any previous cycle. The question is whether something has actually changed about Micron's business, or whether this is the peak of yet another boom before the inevitable bust. In this video, I'll explain what high bandwidth memory is and why AI infrastructure cannot run without it, why only 3 companies on Earth can make it, and what that does to pricing, whether the traditional cycle argument still applies when your entire production is sold out 2 years in advance, and what today's earnings call actually needs to show for MU to be worth owning at current prices. My name is Phoebe, and you're watching Trading Key. AI memory explained. Standard computer memory, the DDR5 RAM inside a laptop or the NAND flash in a phone, is built for cost efficiency. Low margins, high volume, commodity pricing. Micron has sold this kind of memory for 50 years. It's the reason why the company has historically traded like a commodity business, because it is one. Now, high bandwidth memory works differently. HBM is a stack of memory dies bonded directly on top of each other and mounted alongside a processor on a single package. The architecture eliminates the data bottleneck between memory and compute. An Nvidia Blackwell GPU cannot reach its rated AI performance without HBM physically attached to it. There's no configuration of the chip that runs at full capacity without it. Okay, think of it this way. A standard GPU connected to regular memory is like a factory where all the parts are stored in a warehouse an hour away. An HBM-equipped GPU is the same factory with parts stored on the floor beside the machines. The throughput difference isn't incremental, it is baked into the architecture. Each Nvidia H100 uses 80 gigabytes of HBM3. Each Blackwell B200 uses 192 gigabytes of HBM3E. As GPUs get more powerful, the amount of HBM they require scales up, not down. Every increase in AI compute demand is a direct increase in HBM demand, automatically, because the two cannot be separated. Which brings us to our next question. How many companies can manufacture HBM at commercial scale? The 3 companies that can scale HBM: Samsung, SK hynix, and Micron. That's it. No one else has the manufacturing process, the stack bonding technology, or the customer relationships to enter the market in a time frame that matters for investors today. TSMC doesn't make HBM, neither does Intel. And there isn't another Chinese manufacturer that's in this business at scale. SK hynix is currently the volume leader, supplying the majority of Nvidia's HBM allocation. Samsung has struggled with yield issues on HBM3E and has been losing share. And Micron is the fastest growing of the 3. Its HBM production capacity is completely sold out through the end of 2026, with allocation agreements already signed for the majority of 2027. What does a sold-out order book mean in practice? It means Micron's customers cannot wait for a better deal. They can't switch to an alternative supplier overnight because there is no alternative that can absorb their volume. Therefore, Micron is setting price from a position of scarcity rather than competing on margin in an oversupplied market. This is the direct explanation for the margin expansion, from 39% to an expected 80% in 12 months. The product hasn't changed, the supply-demand balance has. Of course, Samsung and SK hynix are not standing still. SK hynix is already ramping up the next gen's HBM4. Samsung will eventually resolve its yield problems. And if AI capex growth slows, the demand currently absorbing every chip Micron can produce starts to look less certain. However, the question isn't whether competition eventually compresses margins. It will. The question now is how long the current supply constraint will last, and whether Micron can use this window to build the cost and technology position that lets it compete effectively when pricing normalizes. So, is this just another boom? Here's where theory and practice diverge, and it matters for how you think about today's report. Conventional memory cycle analysis says, when margins expand this fast and this far, the cycle is near its peak. Suppliers are incentivized to add capacity. Within 18 to 24 months, that capacity arrives. Supply exceeds demand, prices fall, margins compress, and Micron is back at 39% gross margins. This pattern has repeated in 2001, in 2008, in 2016, and in 2022. It isn't simply a theory. It has a documented 50-year history. However, HBM is not a commodity memory product. Building HBM-capable fabs requires capital expenditure in the tens of billions of dollars and takes 3 to 4 years to come online. The packaging technology, where dies are stacked and bonded at wafer scale, requires process expertise that Samsung is still working through. Customer qualification for each new design takes months of testing. You can't add HBM supply the way you add standard DRAM capacity, because the constraints are technical and not just financial. This is why the traditional cycle argument doesn't apply cleanly here. The supply response is slower, the demand signal is different because every new generation of AI chip requires more HBM than the last. After all, a cycle that corrects more gradually and at higher margins than previous ones is a very different investment case than the boom and bust Micron of the last 20 years, even if the direction of travel is the same. What MU's report needs to show. Here's the thing. The Q3 numbers will almost certainly beat consensus. Micron gave specific revenue guidance of approximately $33.5 billion for the quarter, so the result wouldn't come as a surprise. The number that will actually move the stock is the fiscal Q4 guidance. So, 3 possible outcomes. First, if Micron guides Q4 revenue meaningfully above the current $36 billion consensus estimate, and management extends the sold-out HBM narrative into 2027 with specifics on HBM for qualification timelines and customer commitments, the stock re-rates higher. The cycle concern gets pushed further out. Analyst price targets that already doubled start to look conservative. Second, if Q4 guidance comes in roughly in line with consensus and management is cautious about the pace of HBM4 ramp, the stock stays range-bound. You own a strong business at an inflection point, but the near-term catalyst has been absorbed into the price. Patient investors hold, momentum traders move on. And third, if Q4 guidance disappoints, or management signals that a major customer has shifted allocation timing, the stock sells off. The cycle narrative comes back immediately. One specific thing to listen for is what management says about HBM4 pricing relative to current HBM3E pricing. If HBM4 commands a meaningful premium, Micron's margins have room to expand further even as the product generation transition. If pricing is flat or compressed on the new generation, the margin peak may already be here rather than still ahead. The honest case for MU. Micron is not the same company it was in 2022. The product it is selling into the AI infrastructure cycle is harder to substitute and harder to oversupply than standard DRAM. The 50-year history of cyclical busts is a real reference point, but it is a reference point for a different product in a different market structure. The investment case at current prices requires believing that the HBM cycle runs longer and corrects more gradually than previous memory cycles. The evidence for that view is solid. The risk is that solid evidence has historically not been enough to prevent Micron from re-rating sharply when sentiment turns, and the stock's own 50-year track record carries real weight as a warning. The Q4 guidance from today's call is the most important near-term data point. Strong guidance extends the thesis. A disappointment raises the question of whether this is the dip or the turn. So, where do you land on Micron? Buying before the report, waiting for the guide, or staying out of the cycle entirely? Let me know in the comments below. Thanks for joining me today. If you found this video helpful, remember to subscribe to Trading Key. Give this video a like and share it with a friend who might just benefit from learning this too. With that, I'll see you in the next one.